Just 2 days. That's how long the best news in the housing market had seen in 4 years actually lasted. On February 26, 2026, the 30-year fixed mortgage rate had dropped to 5.98%, breaking below that 6% for the first time since September 22. Buyers were celebrating. Agents were lighting up their phones. The spring selling season was shaping up to be the housing market's comeback story. Then, 2 days later, the United States and Israel launched coordinated military strikes on Iran, and everything changed. Now, this isn't a political video, and I don't want political talk. I'm talking about the real estate market here. But today, I'm going to break down exactly what the Iran conflict means for the spring housing market, what's happening to mortgage rates right now, and most importantly, what you should actually do if you're trying to buy or sell a home in the middle of all this chaos. Now, welcome back to my channel. I'm David Karras. If you're new to this channel, I would ask that you hit that subscribe button. I give you no spin, no hype sources on what's really happening in the real estate market around the country. So make sure you hit that subscribe button so you don't miss any updates. Now, I want to be upfront with you today. This is a fast-moving story. The situation with Iran is still unfolding as I'm recording this. So what I'm giving you is the clearest picture that I can paint right now based off of the most current data that's available. So let's get into it. Now, to understand why the Iran conflict is such a big deal for real estate, you need to understand what's happening with the housing market and what was expected to happen this spring in 2026, because the contrast is striking. Now, heading into the year, the stars were starting to align, all right? The housing recovery looked like it was going to happen. Mortgage rates had been trending downward since the middle of November 2025. Home price growth had cooled to its slowest pace since the post-Great Recession recovery. Inventory was climbing, and buyer sentiment was improving. Senior economist Joel Berner at Realtor.com, he described this pre-conflict mood among real estate agents as growing optimism. Price growth had gone up, had slowed. Inventory was up, rates were falling. All three of the dials were moving in the right direction at the same time, which hadn't happened in years. And then that 5.98% rate hit on February 26th. That number wasn't just a statistic, it was a psychological milestone. Breaking below the 6% mark had become a symbol of the housing market, a signal that the worst was finally behind us. And that optimism lasted 48 hours. On February 28th, the United States and Israel launched attacks on Iran, and the chain reaction that followed hit the housing market fast and hard. Now, here is the domino effect, step by step. Domino 1, oil. Iran is a major oil producer, and the conflict immediately disrupted supplies from the Middle East, including through the Strait of Hormuz, one of the world's largest and most critical oil shipping routes. Oil prices spiked. Gas prices at the pump jumped 32% in the coming weeks, following the start of the war. Now, domino 2, inflation fears. Rising oil prices don't just hit you at the gas station. They ripple through the entire economy, right? You got the transportation costs going up. Goods are costing more to produce. Goods are costing more to ship. And that reignited the exact same inflation fears that the Federal Reserve have been fighting the past few years. Domino 3, the bond market reaction. So when inflation fears rise, investors start to sell their bonds. When bonds get sold, their yields go up. And mortgage rates, well, they closely track the 10-year U.S. Treasury yield, and following those yields going higher. Domino 4, mortgage rates are climbing. We went from 5.98% on February 26th to 6.13% by March 3rd, then 6.11% the following week, and 6.22% the week after that. The highest level since December. As of the most recent daily index rates hit 6.43% and are climbing. And that's a move of nearly half a percentage point in less than 4 weeks. Now put that into real dollar amounts. Let's assume you're buying a house for $350,000. and a half a point increase in your mortgage rate, it's about $110 a month that's added to your payment. That's over $1,300 a year, which for first-time home buyers that are already stressed thin can be the difference between qualifying or not. Now, here's where it gets really complicated. Because the Federal Reserve is caught in an impossible position right now. Before the war, the markets were pricing in at least one, maybe two Fed rate cuts in 2026. The Fed had even said they were going to try and get 3 in. Lower Fed rates would have eventually filtered through to lower mortgage rates, which was adding more fuel to the housing recovery. But this Iran conflict changed that calculus entirely. At its March 18th meeting, the Fed held its benchmark rate steady at 3.5 to 3.75%, the second consecutive pause. And here's the alarming part. The Fed raised its year-end inflation forecast to 2.7%, up from 2.4% in December, directly citing the energy price shock from the Iran conflict. Now, the Fed chairman, Jerome Powell, said publicly that the Fed is worried a lot about bringing inflation back down to 2%. And it gets more sobering. Of the 19 Fed committee members, 7 now project no rate cut at all in 2026. Markets are pricing a 50% chance of a rate hike by October, not a rate cut, a rate hike. That's a complete 180 from where we were 2 months ago. So what does all this actually mean if we're trying to buy a house this spring? Let me give you an honest picture. First, mortgage applications are already falling. Mortgage Bankers Association reported a 10.9% drop in mortgage applications for the first week ending March 13th. That is a significant pullback. Buyers are getting spooked, and some are pulling back from the market entirely. Secondly, the lock-in effect is back. Remember all those homeowners who had refinanced to 2 to 3% mortgages in 2020, 2021? They had been slowly starting to consider selling as rates dipped closer to 6%. Now that rates are heading back up, that incentive to stay put, it gets stronger again. Now, fewer sellers mean less inventory, and less inventory means more competition for the homes that are available, which could be a good sign. Third, here's the other side of the coin. Inventory has actually improved compared to last year. Active listings were up 5.6% year over year as of mid-March, according to Realtor.com. Home prices nationally are essentially flat from a year ago, and as of March, a median income household could afford a $331,000 home, which was the highest affordable price point since March of 2022. So what does this all mean for you as a buyer? Well, senior economist Assad Khan at Redfin put it well. Said home buyers in 2026 should not write off homes that are slightly above their budget because there is a good chance they will get some sort of a concession from the seller, be it a price cut, money towards closing costs, or funds for repairs. Now, this is actually a buyer's market in many parts of our country. Sellers are motivated, homes are sitting longer, and while rates are higher than they were in February, they are still well below the almost 8% rates we saw in 2023. Now, if you're a seller, the honest answer is this. Your timing just got a lot harder to read. The spring selling season that was supposed to be the comeback year is now arriving under a cloud of uncertainty. Buyer demand is softer than it was a month ago. Homes are starting to sit on the market longer. The national median is now 47 days. In San Antonio, as of last month, it was 101. And price reductions are becoming more common. But here's what I'd tell any seller right now. Don't let the uncertainty paralyze you. A few key points to keep in mind. 1, buyers who are still in the market right now are serious. The casual window shoppers have stepped back. The people submitting offers in the environment are motivated. 2, if the Iran conflict resolves or de-escalates, rates could come down quickly. If that happens, while your home is already listed, you're in a great position to capture that surge of buyers who come back off the sidelines. 3, you need to price it competitively. Pam Liebman, the CEO of Concorin, group said it clearly. She said, if you overprice your house, it is just going to sit there. In this environment, the homes that are winning are the ones priced right from day one. Now, the most important question on everyone's mind is, how long does this last? And to be honest, nobody knows. Since COVID, we have not had a consistent year. But here are two scenarios that economists are gaming out. Scenario one, short, limited conflict. If the war with Iran is contained and resolved relatively quickly, the economic disruption could be temporary. Oil price stabilize, inflation fears ease, bond yields come down, mortgage rates flow. This is the scenario the spring home buying season gets delayed, not destroyed. Buyers who held back in March and April could flood the market in May and June. If you're a buyer, you may have missed the very bottom of the rates, but you're not locked out. Scenario two, we have a prolonged or escalated conflict. If this conflict drags on, oil prices stay elevated, inflation becomes embedded in the economy, and the Fed is forced to keep rates higher for longer, or even hike. In this scenario, mortgage rates could push towards 6.5% to 6.75%, according to housing analyst Logan Matatami at Housing Wire. Home sales, they're going to stall. Sellers get frustrated. The housing recovery that was supposed to happen in 2026 gets pushed to 2027. Which scenario plays out depends on factors completely outside of the housing market's control or yours and mine. And that's an uncomfortable reality of where we are. Now, given all of that uncertainty, here is my practical advice depending on where you are. If you're a buyer, you're ready to move, don't try to time the market perfectly. Nobody can. Focus on finding the right home at a payment that you can sustain. Get pre-approved now so that you can move fast if rates dip or the right property comes up. Now, ask the seller for concessions. In this market, you have negotiating power. Closing cost credits, rate buy downs, and repair credits are all on the table. Look at an adjustable rate mortgage if you plan to be in the house 5 to 7 years or less. ARMs are pricing differently than 30-year fixed right now. If you're a buyer that's on the fence, set a rate trigger. Decide at what rate you will act, and when it hits, move. Waiting for the absolute bottom is a strategy that rarely works. Now keep watching inventory. More homes are available now than a year ago, which gives you options when you do decide to move. Now, if you're a seller, the first thing I want to tell you is you got to price it right. Price it right from day one. Overpriced listings are dying on the vine in this environment. Don't price to make a profit, price to sell. Now consider offering a rate buy down as seller incentive. It can be more effective than a price cut because it directly addresses the buyer's monthly payment concern. List it sooner rather than later. If rates drop suddenly and demand surges, you want to already be on the market. Now, if you're an investor, this uncertainty creates opportunity. Motivated sellers in a slow market can mean better pricing. Watch the Fed closely. Any signal of a rate cut will move the housing market fast. Look, nobody predicted this. Nobody predicted that a military conflict halfway around the world would derail the best mortgage rate moment in 4 years. But it happened. It's in 48 hours, right? It's deeply connected to global events in ways it wasn't a generation ago. But here's what I want you to take away from this video. The fundamentals of the housing market haven't broken down. Inventory is better than it was. Affordability, while challenged, has improved over the last 8 months. And rates, even at 6.4%, are still well below the peak we hit in 2023. The buyers and sellers who will come out ahead in 2026 are the ones who stay informed, flexible, and don't let fear push them into bad decisions in either direction. Now, if this video was helpful, please give it a like. It genuinely helps more people find this content when they're searching for answers. And do me a favor, drop a comment below. Are you buying? Are you selling? Are you sitting on the sideline right now? How is your market? Tell me what market you're in and what you're seeing. Here in Texas, it's a little bit of craziness here. Now subscribe and hit that bell so that you don't miss our next video. We'll be doing a deep dive on whether the rate buy down makes sense in this exact market environment. That one is going to save some of you some real money. Until next time, I'll see you next video.